Hi, everyone. Welcome to Enterprise Agility World Conference. So we have a special speaker today, Michael Connolly. He is CEO at Sound Agility Consulting and Senior Enterprise Agile Coach. So today we will talk about how we can make a better decision about portfolio, right? About value. So we will talk about what we understand about value. In one side we have our wants, in one side we have our needs. So Michael, this is your stage.
All right.
Welcome.
Thank you, Zygmunt. Hello, everybody. Thank you for attending my talk on portfolio valuation, a different way to prioritize and manage software development, so that we can return a greater ROI from an agile delivery perspective. And so I'm going to share my screen if that's okay. All right. Let me know when I'm
Yeah,
live.
it is on the screen.
Okay, great. All right, so let's get started. So a number of years ago, I took an SPC class, and in the context of getting my SPC, I think it was 3.0, we got introduced to a prioritization method called weighted shortest job first. And I looked at that and I thought about it after the class and everything, and though it's not a bad, necessarily place to start, I just didn't feel comfortable with it. It didn't seem to address what I thought from an investment perspective. Now, I have a background in finance and in investment, capital funding, all those kind of things. And so I spent a lot of time in college studying software investment theory. And so I really kind of started going back to that after that class. And really what I wanted to really try to figure out is how could we look at value, and how could we take an investment approach to that? Because I think we spent a lot of time in the software development and planning world of focusing on budgets as well as cost, but we don't really look at value. Yes, we have some benefit documents that we generate that have some lofty wording, but they don't necessarily quantify the value. And I think that's been, for me, the missing part. And so as I went through this, I really tried to understand what it was that we could do from a value perspective. How would we quantify that? And so as I've gone through this now, we're going to walk through kind of my thinking and how I came about this model, which I've now implemented in several organizations with success in changing the way that we prioritize plan work, but also more importantly, how we talk about the things that we want to do from a value perspective. So I think we all know Agile sells value delivery. Talk to any coach, and they will tell you with all earnest and intent that the most important thing you're going to do is deliver value for the customer. And they're going to look at you noddingly like this. You know what I'm talking about, right? I have no clue what you're talking about. Because we don't have a context in most organizations to really have that value conversation. Our conversations really center around cost and a cost benefit analysis, but the benefits never really get tied out to actual outcomes. I've been on many a project where we're just happy to get it done. We get it delivered, and we put it into production, and we all move on to the next thing, and nobody goes back and actually quantifies with metrics. Did the thing we said we were going to do, did it actually deliver the benefits that we said it was going to do? Now, that's not to say that this whole method of software development, delivery, and planning that we've done for the last 30 years hasn't delivered value. It has. But Agile, even though it has a high focus on value, it has done a very poor job in actually helping organizations figure out what that is. There's no framework. At the end of the day, Agile is really more focused on delivery efficiency and effectiveness, and not on really understanding the value being delivered. That's really incumbent upon your product owner and the organization to determine, is this valuable? And again, we don't have a framework to say, is it valuable or is it not? Just don't know. And we don't take the time to actually know that. So again, Agile sells value delivery, but we don't yet have a way of really easily quantifying it. Now, lots of organizations I've worked with have come up with their own ways of approaching value, but the missing piece is a risk and return, a way of looking at risk and return and quantifying it in a meaningful way. And that's what we're going to talk about here today is taking investment theory and understanding what investment theory looks for from an ROI, from return on investment, as well as a risk perspective. So what's the goal of an investment? Wealth. At the end of the day, the goal of an investment is to deliver long-term wealth. So for those of you who have 401ks and such, you're putting money from your paycheck and you're putting it into a 401k, which is usually an amalgamation of lots of different investment funds. And those funds are designed to generate a return that will give you long-term growth. That's why we invest in 401ks. And so wealth is the kind of qualifier for what it is that we do. Now, if I'm a money manager in the investment world, I'm monitoring the return of my investment, my overall investment, on a regular basis. Is it growing wealth? And if it's not, I'm going to make changes to my investment profile so that I make sure that I'm continuing to grow wealth. Because who's going to invest in my fund if my fund loses money all the time? Eventually we will run out of money and the fund will be gone. And yet I argue in software development, we tend to, invest in things that don't necessarily deliver wealth, even when we acknowledge that it's not going to deliver the wealth that we seek. So one organization that I came into that we were going to develop the model in, one of the first things I heard was about this project that had taken off. And somebody said, oh, it's only going to take a few weeks. We'll get it done. It's going to bring value. By the time I got there, the thing had been going on for 24, 26 weeks. So almost half a year. And instead of one person working on it, now we got 4 people working on it. And at that point, everybody in the organization said, we know this isn't going to deliver the value that we thought we were going to get. Clearly we invested a ton of money into something that at that point they realized wasn't going to do anything for them. So they get no long-term wealth, a lot of expense, and then what happens generally in software development that isn't focused on value, they of course completed the project. Well, they had to, and so they could put it into production, so at least they could capitalize it. So again, they didn't really focus in and understand what's the value relative to doing this. So the goal of the investment that we make, both on our personal, goals, but as well as our organizational goals are important. And generally speaking, we probably have a better idea of what our personal, wealth goals are than an organization necessarily has holistically of what their wealth goals are. Clearly, one of the key things that we look at, from a wealth perspective of an investment, if you're a public company, is the price of your stock. And it was interesting when I was having a conversation with an organization about value. They said, well, we make a lot of investments into our products, but we have big clients who pretty much demand that we do things for them. And so they didn't really have a product roadmap. They didn't have a clear strategic idea of what their products were supposed to do for their industry. They reacted for what their key customers want. And so they made investments in features for a product that only a very small number of people would actually use. And so they had this huge set of features and virtually nobody used it. And I argued, I said, so, they said, well, of course we're delivering value. Our stock price is great. And I said, you have to disassociate your stock price from value. Just because you're delivering value and people, your stock is doing well, it doesn't mean that you're doing as well as you could be. Are you growing long-term wealth? I would argue you're not. And so we had that, kind of deeper conversation of what wealth is. And so we'll get more in today into the strategic nature of what we're trying to accomplish from a value perspective. At another organization I worked at, we just kept, again, same thing. We would work on, all sorts of different stuff with no clear direction, no investment goals. So another part of making an investment is to have goals. What do I expect to get from this thing? If we don't really have that clearly defined, we don't have a way to clearly direct ourselves toward getting that. And I'll tell you, from an agile perspective and a team that works in an agile way, we do a whole lot better work when we know the intent of what we're trying to accomplish. We're more engaged. We're going to come up with better ideas and solutions to deliver that value rather than just saying, go do this, and we don't have any connection to the goal. What are we trying to accomplish? It's just work to us. So, wealth, that's what we're trying to build with our organization. So, the other thing that I started thinking about then was, what's an investment mindset? So there's a clear way that an investor and a money manager looks at their world. They're not looking at just any one thing. They're looking at a broad range of things. And they have to be able to accommodate all of this various stuff. They've got to understand what their finances are, what the opportunities are. When I'm a money market manager, I'm looking at multitudes of companies, and I have to observe and understand, what are they trying to accomplish? And so when I invest in a company, I'm expecting that they understand what their strategies are. They understand what the outcomes of those strategies will be from a value perspective, and they will consistently deliver value, because if they consistently deliver value, their financial results are going to be consistent. Their place in the marketplace is likely to be fairly constant, and they'll continue to have opportunities for growth as they continue to compete within their industry, let's say. So as a money market manager and fund manager, I'm looking at all of these things. And so, again, I'm making, from an investment mindset, I'm making an investment with a very specific outcome in mind. I want to be able to have a portfolio of investments that, when they're put together as a portfolio of investments, then I have an ability to observe, I have an ability to gauge success, I have an ability to analyze, and I have an ability to understand the strategy that I'm using to get that. I'm very clear in my strategy. So, for example, if I want a a portfolio that returns lots of, has a higher rate of return, I'm going to be looking at different things. I'm going to look at high cap stocks, and I'm going to look at other things that are riskier, but I'm going to do so from an informed perspective. So this investment mindset, when we translate it into an organization, is we need to stop looking at cost. And that is always kind of what I hear. It's like, hey, we're gonna spend this much money. Okay, great, we're gonna spend that much money, but exactly what value are we gonna get? Can we quantify it? And that's the key thing here with an investment mindset, is that we're not blindly investing money into something. We're investing money from an informed perspective that says, I'm going to invest $400,000 in these set of features, and these set of features are going to return this value. I can quantify it. So let's kind of dig into the investment theory that I've been kind of talking around. So the investment theory that I really liked and I thought applied was the efficient frontier model with Dr. Harry Markowitz. Now, this model is still used today. So money market and fund managers still use this today. Now, the model itself is highly mathematical, just very, very complex. And when I first started thinking about leveraging this, I thought, of course, well, let's create a whole bunch of, mathematical models, and, everybody will just be wowed by the math and say, well, with that much math, it must be right? But it didn't work. I mean, there was no way there wasn't always enough information necessary that we could glean from our agile delivery capabilities to actually generate a model that would be able to assess return and risk effectively and in a meaningful way. So as you look at this model, what the efficient frontier model is trying to tell you is that on this curve of investments, there's a expected rate of return that we can optimize relative to the known set of risks that we've identified that we can quantify. And so when I first started looking at this, I said, okay, so I think a portfolio in this context is a set of stocks and bonds, let's say. So I'm going to have a set of a mix of stocks and bonds that are designed to return a certain level of return. I want to generate 10% return. I want to generate 5%. I want to generate 30%. And within the context of each of those portfolios investments, then I've got a set of risks that I'm going to be able to calculate and say, all right, for this return, this risk, we're right there. We're optimizing it. We can't get any more return, and we don't need to accept any more risk. Now, we don't look at our software development planning efforts like this at all. So I started thinking about it, and I go, so what is a portfolio in our context? And my first kind of approach to this in STAB was, well, a portfolio is just the sum total of all of our Scrum teams. And I'm like, all right. And I started playing around with that and working through various assumptions and scenarios and stuff. And that just didn't really give me what I thought the organization would need when we're actually talking about value and actually talking about risk. So yes, the Scrum team does generate the value through their efforts. Their efforts to deliver that value, though, are predicated on something else first. It's the identification of value and value outcomes. Our risk is actually more aligned with our team's ability to deliver. So then I rethought it all, and I said, okay, let's talk about a portfolio as an organization. So now we have an organization, and within an organization, we have lots of things that we can invest in. We have product development, we have third-party applications, we have infrastructure and all that. And so some things started looking like stocks. New product development, new features, can be somewhat volatile, like a stock can be. And other things like infrastructure started looking more like bonds. That's stuff. It's not very sexy, not very exciting, but got to do it. And it generates a certain level of return that we need. And in our context, infrastructure investment reduces risk. So now we've got this concept of a portfolio, which is the sum total of all of our software development and technology efforts, needs, and wants. Now, what we want to do is try to maximize our return relative to the risk of actually doing that work. Now, each investment portfolio, whether it be financial with stocks and bonds or organizational with our software development efforts, each one will have a risk return kind of profile generated for it. So again, if I'm young, I'm going to take higher risks in my investment decisions. So I'm going to trend a little higher on that line. If I'm older, retiring, I'm going to trend lower to that line. Same with organizations. If I'm a startup looking to break in or transform an industry or disrupt an industry, and having worked in startups, we're on the right. We're on that higher. We're making risky plays, but those risky plays also have potential for high return. And so again, you're making an informed decision about the risk profile of your organization based upon the things that you value, how you value, and what your strategies are. Now, an organization, and I've spent more time working with organizations to implement this model more on the financial and pharmaceutical side. So they're correspondingly a little more risk averse. So they're going to trend down on this curve. They still want to maximize their return. It's not like they're saying just because we're risk averse doesn't mean that we don't want to make a good return. We just want to make, again, informed decisions about what we're willing to invest in. Now, where we don't want to be is below that line. So if we're below that line, we're basically saying, especially as we move to the right on risk, we're taking on higher levels of risk for lower levels of return. And I would argue, especially in our waterfall planning ways, we're doing that. We're starting off all the, in a much unknown, a higher unknown position. So our risk is higher relative to the return, the value that we expect to get from a project, because historically we don't quantify that return. There's benefits, but they're not hard benefits usually. And so what we want to do is again focus in on shorter deliveries. Shorter deliveries will keep us closer to that curve. Long dig up front waterfall projects are going to push us down, because we don't know yet what the return is going to be, but we can see that there's risk involved in these 18-month, 24-month projects before we deliver anything. So that's one way that you can help your organization kind of visualize what's the difference risk-wise from waterfall and agile delivery. It's in how we visualize that risk. Now, on the flip side, invariably, I come into organizations or I'm working on a project and we'll start talking about it, and the term low-hanging fruit always comes up. Oh yeah, we're going to do this project, and hey, but there's some things over here, low-hanging fruit, man, we do this right away, we're going to knock it out. What we're saying in that context is that we can beat this model, that we can have our returns go really, really high relative to really, really low risk. And so kind of back at that example where, hey, this is going to be a 4-week project and they're now 25 weeks into it. They thought they were going to get that big return for low risk and low effort. What they ended up getting was virtually no return, high risk, and lots of costs associated with that. It's like it would be like buying a stock and holding on to that stock until it's of no value. And what I learned years ago from my professors, as we talked about investment theory, is that there's this notion that you want to basically use other people's money. So if, as an individual investor, I want to be able to invest, let's say, in a stock. I buy it for 20, and I'm hoping it goes to 40. That's my goal. I think with everything going on, it's going to go to $40 a share. Great. I actually want to sell it at 35. I don't want to ride the wave, because eventually that wave is going to break, and it might break before I realize, and then all of a sudden the stock starts dropping. And so we'll kind of get into this notion of, what's our strike price? Where do we stop investing? Either on the upside, is the continuing investment in increasing lower returns warranted? And more importantly with Agile, when do we stop investing in something that clearly isn't bringing value? So this whole investment model is designed to get us into that mindset, that investment mindset of making informed decisions about what's valuable, why it's valuable, and when does it stop becoming valuable? When do we sell? So how do we define value? That's really the crux of the matter here. In an organization, there are a lot of people who want a lot of stuff. They want it. Personally, I'd love a Ferrari. I'd love to be able to toot around town in my Ferrari. But when I strategically start thinking about what my family needs, we needed a big SUV or a minivan, because we haul a lot of stuff, we travel a lot, we got pets and everything. And so having a Ferrari, though, gives me perceived value, I feel really good about it. It actually doesn't provide any real value to the family. And so we really have to start talking about wants versus needs. And as we go through, oftentimes in our annual planning cycles, we cast out to the organization and say, what do you want to do this year? What are the projects you want to do? And it's human nature. I'm running, the distribution center. I have specific things I want to accomplish. I have specific things I'd like to do. And maybe I went to a conference, a few weeks ago, and I saw this really great tool. And it's not that those wants aren't important. And it's not that those wants necessarily can't be translated into needs, into real value. But real value is on the right side. It's the needs of the organization in the moment that we are in. And so when we start looking at value, we want to quantify the value in a way that stays focused in on the strategic needs of the organization. Now, we talk a lot about strategy, but in reality, we don't really focus in on that when we're doing planning. We tend to load up our projects with a lot more wants, with those benefit statements that make it look like it's a need, but in a lot of times it's not. And I've seen this in organizations where you've got one part of the organization actively trying to do something that another part of the organization is getting rid of. And so again, strategy needs to be holistic across the organization. The real value of the organization is aligning strategy across the organization, not within individual silos. So as we talk about value, there's perceived value, things that I get personally, or my organization, my part of the organization would obtain personally, but it may not fit into the whole structure of the organization and the things that we're trying to accomplish. And again, don't invest in things that aren't strategically aligned to where you're going. So where do we find value? It's in our strategies. And I go onto LinkedIn and I read articles. I mean, there's just a million articles about how important it is to understand our strategies and translate those into some kind of meaningful outcome. OKRs are one of the more common ways that we talk about it. And so they're right. We have all of these ideas and we have strategy. What we don't do, and what my model is done, is that we align strategy and we quantify strategy from an outcome perspective. So then we have a mechanism to take these ideas, run them through our value model that is strategically aligned and has strategic outcomes, so that we can have a value score that says, yes, that makes strategic sense. Yes, it has value. Yes, it's something we should consider. It's still not a yes. Just because you get a value score, a high value score, it doesn't necessarily mean that you're ready to roll. There's other things that we'll talk about here that have to go into that calculation of, is this the right thing to do today? And is it the right investment to make today? Just because you can do something doesn't mean you should. If the investment level for the outcome exceeds the value that you're going to get, don't do it. And so, yes, it is very important to take that strategy. And so at one organization, we spent, and I will say, this is the hardest part of this effort, going through the strategies and quantify them. Because again, most organizations, the strategies sit on the side. We pull them out for our town halls and other kind of more broad, important conversations we have organizationally. But when we get into tactical and we're actually executing day in and day out and trying to deliver value, we're not talking about our strategies. We're talking about wants, not needs. We're dealing with the latest fire that happened that probably occurs because we haven't strategically aligned our outcomes. And so this is the hardest part. At one organization, it took us about 6 months to go through all their strategies and then refine them into a model that aligned to strategic outcomes. So again, strategies provide the definition for our outcomes. So now we're kind of getting into the heart of the matter. So as we go through the value model and the building of the value model, our focus then becomes, how do we define outcomes? And those are our value factors. Value factors will drive the valuation scores. Now, strategies enable our capabilities. So we now have a mechanism to grow our capabilities, because that's really the more important part of the organization. When you look broadly at the organization, it has grown up holistically. But almost every organization is going to have very similar types of capabilities. At its core, you're going to have capability of business finance. You're going to have a capability of HR. You're going to have all these capabilities, and all those capabilities are then encapsulated in your value stream. Now, we tend to sometimes, I think, go backwards. We try to go value stream and then try to If we are elected, we'll try to align that to capabilities. I argue that you want to start at the capability level, and then from the capability level, understand the end-to-end value stream that drives all of your capabilities from the time that we first touch a potential customer to the time that we acquire that customer. So we've got a journey that needs to be had, and the value stream really should be talking about that, because it's the capabilities underneath that drive that. And so now we've got strategies that need to be connected to our capabilities. And so that's another part of the valuation model, is working with your enterprise architect to understand what all the capabilities are. And then understanding from a strategic perspective, where do we align those values? Where do we align our teams? Where do we point people to work on that's going to deliver the most value? And I think the key here with this model, and talking with Alistair Coburn a couple of weeks ago about this at a meetup, he was asking about the model, and I think the fact that I was able to convey that the model doesn't just deal with tangible outcomes, it deals with intangible outcomes. So if I've got a strategy, like we did for one organization, of becoming a first-class green organization, that doesn't always have a hard value that we can assign to it, like cost reduction or revenue increases. That has brand awareness, that has other aspects associated with it, but we need to quantify that, because that stuff's important. Maintain world-class security of our products. We talk about it a lot, but at the end of the day, security is just kind of something that's left on the side. Oftentimes, I mean, we do it, but it's not a thing that we strategically think about all the time. But if you're an organization with a huge online presence, not maintaining world-class security probably has a much greater risk to your organization's livelihood. And so we can quantify that potentially. We can quantify the value of maintaining that by looking at the risks associated. If we have a breach of this level, that's going to impact our brand awareness. We're going to lose customers. We're going to lose confidence. We can start to calculate, hey, we're going to lose 10,000 customers if we do that. The average customer spends this much money. We can quantify that value. So as we start thinking about our value factors, they have to be broad, because our strategies are broad, and our strategies tend to be a little bit more altruistic. They're not going to be such that we can just point at this. Now, the other thing that I've coached organizations too is that as we start building our value model, we want to kind of decompose our strategies into a set of value factors, things that we can discuss and talk about. And those value factors, we want to be no more than about 6. We want to keep the value factor in the value scoring model small in context, because we want to ensure that we're always focusing on the most stuff. Now, one organization, they wanted to start bigger. And so we started with like 14 value factors. What we were able to see as we started running our initiatives and ideas through the value score is that things were getting through because it was so broad. You could actually get things through that weren't necessarily driving the value that you needed, and they weren't necessarily always as tightly aligned to the strategies. So my experience with this value model is that you want to have about 6 value factors, and then within the context of that factor, we're going to have 4 levels of outcome. So we give the people who are coming up with the ideas a way to look at their ideas and say, hey, I'm going to do this. I'm going to do an effort that's going to lower costs. But in so doing, we're also going to be able to translate that into a cost savings to our customer. We're going to be able to, by doing this, we'll be able to give them free shipping that we haven't done before. And so we start looking across multiple factors. That's where the real value in the value scoring model comes from, is that we're really pushing the organization to think more broadly about what value is. Don't get myopic. Don't look at just one thing. And you'll see that when the value scores are going up and down. Now, one of the great things about the value factor scoring is that it fosters really, really good conversation. And so the value outcomes then generate the value score. Now, in one organization where we implemented this at, when I first got there, we were going through the transformation, and the leaders, came to me and one by one, and I had one-on-ones with them, and I was talking with them, and they kept reiterating, "Hey, we need a new ERP system." And I said, "Great. What are you doing to get there?" And their response was, "Well, we haven't convinced leadership that they should spend that much money. They're convinced that our old mainframe ERP system can continue to grow and support our organization." I said, "Great. So let's use the value model that we're going to implement as a way of fostering a conversation that will illuminate the fact that you aren't getting the value that you seek, and you can't grow your business the way you want with the current system you've got." So we went through all of that, and we started seeing the ideas and initiatives coming through the value scoring model, coming in at 1.8, 0.5 out of a total of 4. So low value because they couldn't do the things that they wanted to do. The system was restrictive in that perspective. And then the value that they wanted to do and the projects they ended up trying to take on were taking 15, 20, 25 sprints. So we're talking a year to generate something that generates 0.8 value. Huge expense, $40,000 a sprint, $800,000, $900,000 investment to get very, very little value. And so that didn't go on for very long. I was able to kind of help leadership to show, hey, we're spending this much money, we're getting this much value. And then leadership said in a meeting, I get it. Let's move forward. So the value score model isn't designed just to prioritize our work, which is, of course, a key thing that we wanted to do. But it also fosters conversations about strategically what are the next big investments we may have to make. Strategically, what are the things we need to do? And that also then becomes a way for us to talk about business enablers and architectural enablers, that we have to have that balance. So our value score model is such that we can have these strategic conversations and then value score the things that make the most sense. And so an organization has many needs. As I've been talking, you've got infrastructure, you've got business as usual, you want to innovate, you've got growth opportunities. Do we buy versus we build? We need to diversify our portfolio, kind of going back to the investment theory model here. Diversification lowers our risk. So if we put all of our money into innovation, we're going to ignore important things such as the infrastructure and having a good, scalable, secure system. We need to balance what we're doing. So both business and architectural work have value. And when we look at our intake now, so as we organize our intake model, we're bringing in both parts of that equation. Business is bringing in all of their information. Architecture is bringing in all things that they need to do. So at the very beginning of our intake, as we're doing value scores, we're now having that strategic enterprise conversation. All right, we want to do these things. We got to do that. And one organization where they wanted to completely transform how they interacted with their customers, they had to actually transform their entire back-end system before they could even enable any of that. And so we want to have these strategic conversations. We want to have value scores that allow us to have a strategic conversation, because if we don't, we're going to start working on something, and then we're going to realize that we're already down the road before we realize that we have to make different investments. We have to undo things. So again, think diversification. And we can't always have these cutting edge projects. We have to balance our investment that way. So what changes with value-based planning? Well, we want to move to continuous intake and execution. Is that what Agile is all about? We want to continuously, you know, take in work, and we want to continuously deliver value. That's what the coaches tell us, right? But what's been missing in the whole equation is this value realization. So we want to continuously intake and deliver uh, smaller, increments of value, but we need to stop, and we don't do that. We certainly don't do that in waterfall, but in Agile we don't usually do it either. When we do an MVP, when we're saying this is the first piece of value that we think is going to deliver the strategic outcomes that we've identified in our value model, stop. Just stop. Don't do any more work. Let that information, and it might take 2 or 3 months for the data to be realized in a dashboard that we can say, hey, we anticipated reducing costs by 10%. Great. The MVP actually reduced it by 8. Now, do we want to continue to invest to get that other 2%, or are we happy? Again, that's up to you as an organization. But we have limited capital, we have limited capacity, so we don't necessarily want to overinvest either. Again, that notion of, hey, I'm going to sell, I'm going to stop before everything has been realized because I may go too far. And in another organization I was at, we did just that. We sat down with the business and we want these things done, and we broke it down and said, all right, we're going to do this first set of work. And we put it into production, and it started producing results fairly quickly. And they said, you know what, that's good enough. We have another thing we want you to work on. That's the power of Agile. And that's what I want leaders to understand when we're looking at value-based delivery, is that you have the power to stop investing in something that doesn't deliver value. Not all of our ideas are going to pan out. That's the reality. But if we have funded teams rather than funded projects, now we can say, all right, you know what, that idea didn't work. I don't have to worry about the project funding because there is no project funding. There's the team, and the team's focus on value. And so if they're not delivering value, stop that work and move to the next thing that will. Because it's the ability to deliver value that basically gives us the reason for the teams to exist. So again, manage your investments incrementally. It's not a big upfront project. It's work that we're going to look at and we're going to deliver incrementally. The lean notion of there is value in work not done is an important one. Don't continue to invest in things that are only giving you incrementally lower value or potentially going the wrong way. And yes, as a good investor, as a good steward, the fiduciary responsibility is to realize value early and often. Now, we don't usually use the word fiduciary within the context of software development, management, and delivery, but that's really what we need to do. We have a fiduciary responsibility in the organization to work on stuff and do it in a manner that delivers value, but doesn't over-invest in that value. Now, one organization where I was a test engineering manager, we were working on a complete rewrite of a product that we had. It was in dire need, and it was going to be kind of launched with one of our biggest clients. And we started doing the work. Now I'm on the test side, so we're testing, but the project kept going and going and going and going. And finally, it got killed. The customer said, you know what, you've taken so long, forget it. We're just not going to do that, because we couldn't show them anything. And I'll never forget, at the end of that project, the engineering manager came to me and says, Mike, if they only knew all the cool technology we had done, they would just be so amazed and they'd want to keep going. I said, no, they actually don't care. We didn't deliver value that they needed to consume from us. They didn't care if you did it in MS Access. And so sometimes, yes, we do get enthralled with the technology we're working on. So we want to stay focused on delivering incrementally so that we have value that we can see, realize that, and stop investing when we don't need to invest anymore. There's too many things to do in an organization from a technology perspective. I hear it all the time. We have 3 times the work of the people that we have available. Great. So let's stop trying to work on all of that at once and let's get focusing on what's the most valuable stuff we can do now. So we've been talking about return and strategic alignment and outcomes and all that, but the model, an investment model, and the model that I'm basing all of this on still has risk as a piece of the puzzle. Now, again, I tried to figure out how do we quantify risk? Is there a mathematical model and everything? But really what I came down to is it's our teams, our agile teams, our scrum teams, who actually represent the risk in the most probably meaningful and appropriate way. Because it's the teams that are impacted by everything that goes on around the organization. If we have a flow problem and work isn't flowing to our teams consistently, we're going to have uneven results. We're going to have uneven, value delivery. We're not going to be as productive as we potentially could. If our technical stack doesn't allow for, let's say, high amounts of automation, whether it be test automation or build and release automation, that's going to slow them down. And so I started thinking and looking, it's like, well, our teams actually are the risk module. And I know that, we don't like to put that pressure on teams, but at the end of the day, they're the ones being tasked to do work. The work is flowing to them, and they're, trying to make commitments to deliver that, all things being equal and all the things that can affect them. And there are so many different things. We know as coaches, and having worked, in Agile before I became a coach, there's just so many things that can disrupt us. There's so many things that can get in our way. The organizational, pressures and noise can really be disruptive. And all that disruption equates to delivery risks. So, great, we got risk at the team level. Now I'm probably getting into an area that gets, coaches a little uncomfortable. But we need to quantify that risk. And no matter how I went around it, I'm using the words inconsistent cadence for a reason, because in Agile, people get very uncomfortable with the word predictability. But at the end of the day, that's what we're talking about. We're talking about our ability to consistently deliver something. Now, the reason predictability gets kind of the bad name it does in Agile is that typically in an Agile organization, we're still a lot of waterfall there. And so we have our annual planning cycles, we have fixed scope, fixed date projects, and then the teams are expected to deliver that to a fixed date in 2-week sprints. That's not how this works. That's not how Agile delivery works. That's not how you build agility. You build agility by ensuring that the teams have a clear understanding of what the value proposition of the work they're going to do, and you let them do it. And so when we look at quantifying the risk for a particular team, we're really looking at the team's ability to plus or minus, in this case, I'm using velocity as an easy example. You can use number of stories, and there's other ways that we can approach that. But ultimately, what we want from our teams is to become effective, mature, and confident in their ability to estimate their work and to deliver that work. Because that builds confidence in them, and it also builds confidence across the organization that when we come to them in this model, this value model, it says, all right, I've got a value score of 4. You guys tell me, what's it going to take to get this done? What's the estimate? And so we have to start baking in the costs. So we have to have a mechanism that says, how do we develop costs? Well, it's a funded team model. So we know what the per sprint cost is in a funded team model. On average, about $40,000 a sprint. So if the team comes back and says, hey, we think it's about 10 sprints, then we know at a very rough level, we're about to make a $400,000 investment in whatever it is that we've decided and we've quantified has value. So we can see the quantifiable outcome, which better exceed 400,000. Because if it doesn't, why do it? So now we have a mechanism for that. And it's the team's predictability that allows us to kind of look at that and say, okay, I'm good with that estimate. Now, if they're unpredictable And again, the unpredictability generally is not because of the team. It's because of the team's noise level. The things constantly interrupting, teams. And so oftentimes as a coach, we know that the team's unpredictability in delivery has more to do with things outside of their control. So we'll focus our attention on fixing that in the context of building the value model. So if they're unpredictable, then we're going to quantify a risk score. So looking at, X number of sprints, we develop a risk score. If they're more than, plus or minus 10%, they become a potential negative score. So they come back and they say it's 10 sprints, but they have a risk score of 0.5. We might say that 400,000 investment might be 600. And again, we may still do it. We just want to make an informed decision. So again, predictability, inconsistent cadence is the thing that we're going to focus in on to quantify the risk. And we're actually going to deprecate our score. So we've got this value hypothesis, we've quantified it, we've got our delivery team, and now we've got the risk of our delivery team. So we take our value score minus our risk score, and now we have a risk-adjusted value. And then, in one situation, we had a team that was inconsistent, and what was a 4 ended up becoming a 3.3. Again, it was an informed decision that we knew that the estimate that they gave us might be a little bit more expensive, potentially a little less, but in general, we'll assume that it's going to be a little bit more. And what was interesting in the organization where that happened, and we had the model, the director of finance, as we sat in our business guiding meeting, so we had everybody involved in really looking at intake and value scores and all of that. One of his first questions was, all right, what's the predictability of the team? And by having that risk score capability, he could then in his head go, okay, so it might be a little bit more. Yeah, it might. And then we can have that conversation. Is it still valuable? And then ongoing, if the team comes back and says it's going to be 10 sprints, we're going to track that. We want to see, are you guys tracking to completion? Now, they may not for whatever reason. And again, it's okay. We're not saying it's not. We're just saying we want to be transparent. We want to be transparent. We want to be accountable, and we want to be predictable. And so, at the end of the day, cost must be a factor. We're coming all the way around. I've been saying we don't want to talk about costs. We don't want to talk about budgets and stuff like that. But when we're making an investment, cost matters. Something that looks valuable may not be. And I don't know if I gave the example already, but in one situation, yes. And we came in and we said, this is a great idea. We agree with you. Business said we want to do this. We went off, did a spike. We came back. We said it's about 20 sprints. And they're like, no, there's not enough value there. Valuable at 5, but not valuable at 20. So cost will impact ROI. It's just the same. You can't, as an individual investor, I'm not going to go out and buy tons of Google stock and Amazon and all that stuff. They're really, really expensive stock. I'm going to focus my investments in a different way. And so we have to understand that the cost of something at the end of the day has to impact our ROI. And finally, really what we're trying to do with all of this, with an agile intake and a value model that provides scoring, we're answering 3 questions. Should we do it? Can we do it? And will we do it? So the value score answers the first one. Should we do it? Is it strategically aligned? Does it deliver the value score that we want to be in, for our risk return profile? Great. Now, before we decide to actually go do it, we need to give our teams time to identify, can we do it? So in that scenario, we can do it, but it's going to be really, really expensive. So then we answer the question, will we do it? No. Now, we ended up doing something a little bit differently, but these are the questions you should be asking and answering as you go through an agile intake, value-based delivery system supported by the models that I've created. Because just because we can do it doesn't mean we should. And that's sometimes a really hard one to walk away. If people get excited about doing something, but if the cost acquiring the value exceeds the value itself, well, then it's a pretty simple equation. Don't do it. And so with that, I'm done. I'd like to thank everybody for listening in. Um, if you're interested in learning more, certainly reach out to me. I've got various ways that you can reach me via email, on my website, follow me on LinkedIn, or you can even find my writings on Medium.
Thank you, Michael, for your presentation. It was great. At the beginning, we had some technical issues, so stream a little bit stop and start again. So let's check whether they have any question or not. Our audience.
So did most people miss it?
At the beginning, there were some technical problems, but I think it's okay now.
All right.
So let me ask, while we're waiting, a question. So where should we start if we think about this model?
Yeah, so where I've implemented it now, where I start with the organization is to look at strategy. It's actually twofold. I look at strategy, and then I look at their enterprise capability model. And if they don't have one, we're going to generate that. Now, not everybody has an enterprise architect on staff, so sometimes you're going to have to go out and get one. But at the end of the day, we want to develop an enterprise capability view that we're then going to align the work that we do. But I always start at the strategic level to make sure I understand the strategies. And then, yes, we go through many, many different variations of what those strategic value factors end up being, because that's the heart of the engine, the model. And if we don't get that right, then the scoring mechanism is not not going to deliver the results that we're seeking. And I also say that work also touches on politics and culture and everything. People have very strongly held beliefs about, what their strategies should be or how they should be interpreted. And so it's not it's not an effort that isn't without its diplomacy.
Thank you. Okay, so let's check any questions. I'm not seeing anything. Maybe they will reach you after the session via your contact information, and we will also share a document with them.
Fantastic.
As a takeaway, yeah.
Well, again, I thank everybody. I also apologize that we had some technical glitches, such as the life of virtual work that we do. So yes, anybody has any questions or anything, just feel free to reach out to me.
Thank you so much. Thank you so much for your presentation and explanation. It was delighted.
Absolutely, my pleasure.
Yeah. So then see you.
All right. Bye, everybody.
Thank you so much. Bye.